2023 has started really positively for equity investors after some poor returns in 2022. The FTSE 100 is reaching all-time highs and is closing in on the 8,000 level. But with inflation running at 5.8% in Spain, investors in cash are going to see real losses in value over time unless they take investment risk. So in this video, I'm going to tell you why it's important that people moving to Spain today need to be embracing investment risk and how we can get the risk return ratio right for people. So if you're ready, let's go. My name is Gerald Turner. I'm a chartered financial planner based here in Spain. Nothing I say here is financial advice. It's purely for informational purposes only. It's based on my own point of view after years and years of experience. Over the years, I've met hundreds, if not thousands, of British people who have come over to Spain to make a life here. And these aren't the most naturally cautious people in the world if you think about what they've had to overcome to come here and the risks that involves. And they're quite accepting of currency risk because a lot of them will have pensions, private pensions and state pensions that will pay their income in pounds, but their living expenses will now be in euros. So they're quite accepting of currency risk. But when it comes to investment risk, they're very, very wary. So when I meet them, they pretty much all say the same thing, and that is that they're low risk investors. And if you think about it, that makes a bit of sense because the money has got to last them. They're not going to earn any more, and they don't know how much longer that is going to be for. So it's understandable they want a low risk investment or a guaranteed rate of return. So let's consider some figures if you leave all your monies in cash. It's February 2023 and the European Central Bank rate is 2.5%. The best one-year deposit rate in Spain is around 3%. And inflation is currently running at 5.8% in Spain. So an investor earning 3% interest has a real loss of 2.8% per annum guaranteed. Now let's assume that for 10 years you are withdrawing €5,000 from a pot of €100,000 and it is growing by 3% a year, but losing real value after inflation of 5.8% by 2.8% per annum. The fund after withdrawals and inflation is going to be worth the same as €30,000 today. So although you have withdrawn €5,000 for 10 years or €50,000 in total, in real terms you have lost €20,000. If you have €100,000 in cash that is paying 3% per annum interest and you are drawing out €5,000 every year that is increasing by 5.8% every year to keep pace with today's inflation, you run out of money in around 16 years. The average 65-year-old can expect to live until he is 83 years old. And for a lady, she can expect to live to 86. So for the average person, the last few years are going to be spent with no monies from their savings. There is no money left. Please bear in mind, we have assumed here that interest rates and inflation stay the same for 10 years, which they won't. It's just to show that inflation is the real risk people face with investments. Now this problem isn't new, but with interest rates on the rise, people are saying they can get 3% at the bank. Why do they have to accept investment risk? Only a year or so ago, banks were offering zero interest, but inflation was running at 2%. The reason you can get any interest is because we have inflation. Central banks use interest rates to fight inflation. And unfortunately, because there is a huge amount of government debt in the world and people are very much mortgaged up to the hills, it's very unlikely that interest rates will keep pace with inflation in the near term. Over the years, I've seen all sorts of schemes that try and help people to overcome this problem. People want to believe that there is some form of low risk, high return investment out there. But believe me, 7% guaranteed returns do not exist. I've seen structured notes that say they're going to return 8% per annum that are linked to the returns of, say, the Indonesian or Brazilian stock market. They're usually marketed by huge American investment banks, but the risks are huge and they're often not explained to the people buying them. And therefore, they are not suitable for most people and shouldn't be anywhere near their pension or investment portfolios. The only answer is there is no one answer that's right for everybody. For anyone retiring today, it's a balancing act. But a large portion of your assets should be invested in a globally diversified mix of bonds and equities, because hopefully you will live a long time and this will give your portfolio a good chance of retaining its real value against inflation. And why wouldn't you want to own small parts of the great companies of the world that are driving forward innovation and providing real growth? Because when I talk of stocks and shares or equities, what I mean is owning part of Apple or Amazon, AstraZeneca, Tesla or Volkswagen, some of the great companies that drive forward real growth. And the real risk for you is not owning part of the world's best companies and sharing in this global growth. So let's take a look at some investment mixes and see how they've performed over the last 10 years against inflation. And you will see that the greater the equity exposure, the greater the perceived risk, but also the greater return. On this slide, you can see that over the last 10 years, Spain's average inflation has run at 1.7%. The Morningstar Euro cautious allocation has returned 2.04% over this same 10-year period. That's with a 17.5% equity exposure, 82.5% bonds. The moderate allocation, shown here, has returned 4.71%, and that's a 50% equity exposure, 50% in bonds. The aggressive target allocation, again, has got a greater return, and this is returning 7.28%. But this has 82.5% in stocks and shares and 17.5% in bonds. So just looking at all these figures, then you see a high equity exposure should be the answer. But unfortunately, this has a cost too, and that cost is called volatility. With an 82.5% equity exposure, the value of the portfolio can and will fall quite substantially at some points in time. Equity markets generally go up 3 out of 4 years, but can suffer losses, and quite large losses, in 1 out of 4 years. During COVID, this index of 82.5% equity lost 25% of its value, and this is too much for most retired people to contemplate. Please bear in mind that this is looking backwards, and there is no guarantee that this performance will be repeated over the next 10 years. So for most people, the answer lies lower down the risk scale. And in order for us to find a balance that's right for you, we use a questionnaire devised by Oxford Risk. This questionnaire tries and captures where your comfort level is. Where can we get you in enough risk assets so that you can see real growth in your portfolio, but not so much that the volatility will keep you awake at night? I hope you can see from what we've discussed today that the safest asset class, cash, really isn't that safe for most people. Inflation is a real danger, and most people should be looking to embrace some investment risk in their portfolios. If you enjoyed this video and want to see some more, please subscribe. If you have any queries or comments, please make them below. But thank you for your attention today.